Ladies and gentlemen, good day and welcome to CreditAccess Grameen Limited Q4FY22 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bua from ICICI Securities. Thank you, and over to you, Mr. Bua.
Yeah, hi. Thanks, Hello and good morning to everyone. Welcome to the CreditAccess Grameen Q4 FY22 earnings conference call. From the management team, we have with us today Mr. Uday Kumar, Managing Director and CEO, Mr. Ganesh Narayan, Deputy CEO and Chief Business Officer, Mr. Balkrishna Kamath, CFO, and Mr. Nilesh Dalvi, Head Investor Relations. I will now request Mr. Uday Kumar to take us through the earnings highlight of Q4, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Ramesh. Thank you, Ishik. Good morning to everyone. Our sincere thanks to all of you for joining us today morning to discuss our fourth quarter and FY22 financial performance. We have successfully navigated the year, achieving our annual performance guidance on the back of our robust operation controls and catering to pent-up demand in rural India. The rural economy is showing strong signs of rebound, coupled with an expected good monsoon providing a boost to the fortunes. Our consolidated gross loan portfolio grew by 22.2% YOY to rupees 16,599 crores on the back of 38.2 lakh borrowers. The borrower base shows a 2.2% YOY decline due to 3.8 lakh borrowers written off during FY22. However, on a Q2 basis, we have registered a 2.3% increase, giving strong borrower addition traction in Q4/22. We added roughly 3 lakh new borrowers in Q4 FY22 on the back of an expanded branch network and stable operating environment. Over the last 12 months, CA Grameen acquired 5.8 lakh borrowers, of which 49% were outside the top 3 states, showing results of our calibrated diversification efforts. In the same period, NMFL added over 1 lakh new borrowers, of which 49% were outside Tamil Nadu. Overall, disbursements grew largely in line with the portfolio growth on a YOY basis to rupees 5,700 Q4 FY22 on a consolidated basis. NMFL is continuing to show a strong growth trajectory, with 65% of the book being converted to CA Grameen model at the end of March 22, depicting very superior asset quality. A bucket of products and services are being offered based on our credit line concept with flexible repayment options largely weekly and bi-weekly. At CA Grameen, collection efficiency has largely stabilized, reaching 96% excluding arrears, while including arrears figure stood at 97% in March 22. Excluding non-paying NPA customers, collection efficiency touched 99.5 for the same period. The collection efficiency at the NMFL, which constitutes 17% of our consolidated GLP, has been consistently improving, with 92% collection efficiency excluding arrears and 94% including arrears in March 22, compared to 89% and 91% respectively in December 21. Collection efficiency for April has improved further to 97%, excluding and including arrears for CA Grameen, and for Madura it stood at 92% excluding arrears and 93% including arrears for the same period. The asset quality at CA Grameen has shown remarkable strength, with the PAR 30 reducing from 5.6% in December 21 to 3% in March 22, whereas PAR 0 stands at just at 2.6%. At NMFL, PAR 30 reduced from 11.1% in December 21 to 7.5% in March 22. On a standalone basis, our NII grew by 10.4% YOY to rupees 446 crore, while NIM stood at 11.5% for Q4 FY22. Adjusting for the impact of interest income derecognition, NIM would have been 12.5%. The cost-to-income ratio stood competitive at 30.4%, while OPEX to GLP saw a reduction at 4.5%. PPOP grew by 10.9% YOY to rupees 332.2 crores. The credit cost was rupees 128.3 crores, which also included the impact of write-off of rupees 243 crores. The credit cost was partially offset by rupees 20.8 crore bad debt recovery during the fourth quarter. PAT for the fourth quarter was rupees 152.1 crore, leading to ROA of 4.1% and ROE of 15.6%. GNPA at 60 DPD reduced from 5.5% in December 21 to 3.12 in March 22, and NNPA reduced to 0.9% as on March 22. Part 90, which is standard across companies, stands at 2.26%. The ECL stood at 3.19%. On a consolidated basis, our NII grew by 11.4% YOY to 1,653.2 crores for FY22. PPOP grew by 13.2% YOY to rupees 1,077.5 crores. Credit cost declined 22.6% YOY to rupees 596.7 crores compared to 771.4 crores a year ago. Budget recovery stood strong at 74.1 crore in FY22 compared to 15.7 crore in FY21. PAT for FY22 grew by 171.8% YOY to 357.1 crore, resulting in a ROE of 2.2%. On a consolidated basis, our GNPA was 3.61% and NNPA was 1.31% as of March 22. Liquidity continues to remain comfortable with total cash and cash equivalent to rupees 1,761.4 crore, amounting to 10.1% of total assets, while capital adequacy remains strong with 20.8% at a consolidated level. We'll continue to tap newer geographies and cater to unsolved and underserved markets as a part of our capital creation story at the bottom of the pyramid. A total of 211 branches have been opened during FY22, of which over 91% came outside of the top three states, while overall branch network stood at 1,635 at the end of March 22. The Q4 has been a pivotal point in the Indian microfinance industry, with the awaited new microfinance guidelines announced by the central bank, creating a level playing field. CreditAccess Grameen, being the industry leader, is at the forefront to capture the massive opportunity with its deep focus, competitive interest rates, one of the highest customer retention, and strong governance standards. The microfinance market's scope has widened with rupees 3 lakh household income, providing us a significant head start for market share expansion and increased retention of our higher vintage customers, given our unique customer-centric business model. We are set on a very exciting journey of catapulting from serving one woman per household to meeting the financial requirements of the entire household by leveraging our microfinance system and increasing wallet share per household in line with our Vision 25 of being a preferred financial partner for low-income households. We take cognizance of the rising interest rate environment scenario and believe that we shall continue to remain competitive. The new microfinance guidelines announced by RBI allowing us risk-based pricing will have a positive impact on loan pricing. Any limited increase in the cost of borrowings can be gradually passed on to the new disbursers, partially offset by moderate margin compression in the existing loan portfolio. Further, compared to FY22, FY23 will witness lower interest reversal and lower negative carry impact on account of excess liquidity, which will boost net interest margin. Based on our current estimated liability profile, we believe that even at a 100 basis increase in benchmark rates, and even if entirely passed on by the lenders, which would result in 30 to 75 basis increase in average cost of borrowing by March 23 compared to March 22. An increase in the rate of floating rate borrowings will be partially offset the decline in the share of higher cost fixed rate borrowings. Hence, we believe that our average cost of borrowing for FY23 remains at the range of 9.3 to 9.4% on a consolidated basis on such a situation. Overall, we foresee NIMs to improve by 50 to 60 basis in FY23 compared to FY22 thanks to risk-based pricing. Assuming a stable operating environment, we look forward to achieving loan portfolio growth of 24 to 25% in FY23. Our portfolio growth may remain muted during Q1 FY23 as we implement the new RBI guidelines on the field and ensure required trainings on new processes and controls to all our employees. Also, many of the processes, including reviewing multiple trade bureaus, assisting FOIR of the journal, etc., will remain in manual process for a few months. However, we are confident of achieving the guided growth for the financial year. We are anticipating a credit cost of 1.8 to 2%, which will include the impact of residual write-offs on account of COVID during Q1 and Q2 for CA Grameen and NSL book. Overall, we aim to achieve an ROE of 4 to 4.2% and ROE of 16 to 18% in FY23. On integrating platform along with MSL, underpinned by our rural focus, customer-centric approach, strong liquidity, capital adequacy, highly experienced management, and strong balance sheet places us at the forefront to drive growth in the largest microfinance industry in the world. With this brief note, I would like to open the floor to you for any questions. Thank you. Thank you for patience.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Nikhil Rungta from the Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for this opportunity and congratulations on this great set of numbers. Sir, two questions from my side. First is, you have already given a slide on how Grameen is well placed in the rising interest rate scenario, and you based upon that in your opening remark as well. But I just wanted to know, historically, whenever Grameen has been in the rising interest rate scenario, how has the portfolio performed?
So in the rising interest scenario, what is our strength is to play a best case for our customer, Nikhil. If you observe, we have been able to price much better among the industry players for our customer, which always helped us to retain our customers and manage our portfolio better. And we are able to give without modification of NIM. By and large, the NIM remains same despite interest rate hike or something. So, for example, FY29 and FY28 and 20, and there was higher interest rate scenario. Our NIM used to be around 1.5 and 12.7 actually. We're able to manage better and we are able to price better. The competitive edge always there, being a largest player and ability to negotiate with the bank for the better price, which also helps us to price our customer and retain our customer and also build our portfolio, which always helps us.
Okay. And so whatever impact we'll see will be taken care of from rising yields. Can we say that?
Absolutely. We are not actually expecting any reduction in NIM on account of this. It will be only improved because we have a double impact. One is, our repayment obligations are high priced, and borrowing is lower price than the current average borrowing cost actually. That is why we expect that even if 75 bps increase for a 100 bps increase in the financial year, our actual increase may not be more than 20 to 30 bps actually. And we have ability to pass on the price, pass on the cost to customers. And third one is ability to price based on risk, where risk is higher, price little higher, which will be additional advantage.
Right. So, second question is, you have mentioned that provisioning in FY23 could be in the range of 1.8 to 2%. But on a normalized scenario, you have always highlighted that the sustainable provision should be around 1.4 to 1.5%. So, can we say that this additional 30 to 40 basis point is because of write-off of this pending things which are there, and this will be taken care of in earlier quarters itself?
Correct. So we need to recognize that we still have 1.3% NNP as of March 22. Correct. So this will actually get written off, or the cost will have to be taken in the Q1, Q2. So that is why the average cost probably will go up to 1.8 to 2%, including those costs.
And we'll maintain the policy of NNPA at 0%.
Most probably, yes, because we'll go by the India's route, on the ECL provision route. It all depends on how the stage 1, stage 2, stage 3 behave. To a large extent, we will continue to recognize early recognition of risk, which is going to be our character continuously.
Okay. Perfect, sir. That's all from my side, and wish for the future. Thank you.
Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Thank you so much, sir, and congratulations for a great set of numbers. Two questions from my side. One, if I look at assignment, we have gone a little slow this year, and consequently the income from that part is also significantly lower versus last year. So one, what was the sort of thought process behind the assignments this year, and how do you see direct assignment funding targets for next year? That's the first question. Secondly, in terms of our gross stage 3 and next stage 3, I can't find actually the absolute numbers in the presentation, so if you can probably help with that. And the last question is on the OPEX side, that this year we have seen an OPEX growth of around about 20%. For medium term, let's say next 2-3 years, what could be the expense growth, and would there be any savings on cost income ratio?
Sure. So DA is one which is actually an instrument which we use as a short-term funding only where there is a demand or request from our lender, because we prefer borrowing term loan. We normally not prefer to do assignments and reduce our balance sheet with efficient and adequate capital adequacy, or we wish to grow in the balance sheet, not to do DA. But sometimes we have to oblige some lenders who require the DA. That is where we do, because it's only based on the demand from the bank. Otherwise, we prefer not to do DA. So that's the first question. Based on demand, wherever we have to sometimes oblige. That is why we do DA on the DA front. Otherwise, our interest is not to do DA. We want to grow in the balance sheet growth rather than DA, through DA. Gross stage, maybe Neeraj should do. Before that, OPEX, I will tell you. OPEX will actually continue to go down based on economy of operation. Maybe a bit of exception we would see in the first half of this year while managing the new regulation. Maybe we'll have some inefficiency because of manual processes we have to follow. But it will remain lower than the current year for next year. But while we are already in the optimal OPEX stage, the reduction will not be very high. It will be lower. So probably we took 4 years to bring it from 6% to 5%. Probably we will need another 4 years to take it from 5% to 4%. So that's why when we are in the OpEx, optimal level of OpEx, the change will not be very fast. It will be slow, but it will be continuous improvement. The asset actual number.
Kashyap, it's on slide number 8 and slide number 10.
Yeah, there is a reconciliation of entire number.
Slide number 8 we have given for CA Grameen standalone, wherein the GS3 is 3.1% and net NPA is 0.9%. And on slide 10, it is for Madura, wherein the GS3 is 5.8 and NNPA is 3%.
Thank you.
Yeah, and then thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Amarnath from Ministry of Finance of Oman. Please go ahead.
Yeah, hi, am I audible?
Yes, sir, you are.
Yeah.
So, considering your past performance and the current year GLP growth of 22.2% and all the favorable points you said so far, I'm surprised why the future guidance for GLP is just 24-25%, when everything is fall into the place in current year and maybe next year. Is it a conservative assumption or there is a headroom for it?
Actually, as the base increases, speed of the growth need not be exactly when the base was small, right? So it's actually a kind of industry growth over the industry growth. Probably we would expect industry growth between 20-25, and we would actually match the industry growth or beat the industry growth. When the size was small, what you say is right. The growth number can be more and more. The ability of growth is linked to ability of establishing your infrastructure across the geography, ability of recruiting manpower and train for the quality operation implementation, because microfinance is not just distributing money, it's lending, it's a collection business. We need to have a right kind of employee infrastructure, right kind of employee, right kind of employee training for adequately for the growth. So we need to be very careful in choosing the geography, choosing the right people, and train and grow. So I definitely feel that 24-25% is a reasonable good growth. It is not conservative. It is well thought growth.
Sir, I understand this part. What I'm trying to say, sorry to say, that the last 2 years, because of this Corona and COVID, we keep on increasing our infrastructure. That infrastructure part is good that we keep on increasing. But because of the outside environmental situation, we did not able to grow our book, and that risk was there in the market. So we better conservative and in the last 1.5 years. Now all those cumulative impact of whatever you have done is supposed to be flow back quite nicely in the next 2-3 years.
Happy to have that, but for FY 2021 we are not added the branches. Probably you missed that because of the COVID year. We are not added any branches. Only last year 2021-22 we added branches. That is one. Two, as I explained in my opening remarks, Q1 will be muted growth. There may not be muted growth because of the implementation of new regulation. Probably we will really get only 3 quarters to grow with speed. That's why we estimated, and it's a well thought process.
And second question, so relating to fuel this kind of a growth, assuming 25%, say for next 2-3 years, the current level of capital adequacy what you have, will it be, and whatever the profit you will accrue, will it be enough, or we need to have some kind of a capital raise? And second, the associated question is, say for example, management decides that we want to grow more than 25% because the market is giving that opportunity, because many of the small people in the market, either they have vanished or they have consolidated here and there. So the bigger player like you will always have a higher opportunity, especially the business and economies open up, and the demand for the microfinance loan will be huge. supported by this RBI new guidelines. So I'm just trying to understand whether the current level, though our capital adequacy currently quite high, will it be enough, or within 2-3 years, or maybe 1-2 years down the line, we need to raise capital?
We might raise capital, but not immediately. Probably, as I said, maybe 1 to 2 years down, probably we need capital, but at least because we want to continue to maintain adequacy more than 20%. With that context, we might have to go back to raising capital in the next 6 to 7 quarters.
And this due to this new RBI guideline, and since we are probably one of the lowest charging interest rate in the market at the moment, what is your best estimate? How much our yield can improve? I remember in the last call you have given, though it was not confirmed at point of time, but you have given a basis that around 150 bits of yield increase is possible if the RBI now they have done it. So do you believe that you will be able to maintain that 150 bits what you given last time, or it will be more or less?
So actually now this the increase in price will come gradually because this will be only with the new disbursements, not with the old disbursement. Repricing is not possible in microfinance. However, we are already complied and published our interest rates as per the new policy, and we already complied on everything on the RBI policies requirements. We presume that 50-60 bits increase is possible for this financial year because the future disbursement only will get the benefit of new pricing. On average, pricing increased by 1.25 to 1.5% actually, but your gain for the year would be about 50, 60, 70 bits. The full impact would get in FY23-24.
Thank you. Amarnath, I'll request you to come back in the question queue for a follow-up question. I request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next participant is Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. And three points. Firstly, what is the expectation of new customer acquisition for FY23? Secondly, how should we think about the increase in share of 3-year tenure loan? I understand it's quite positive from portfolio rundown and from customers' monthly EMI outgo, but are there any downside or risk to this strategy? And thirdly, sir, what is the yield strategy? If you can explain to which customer, how are we deciding that to which customer, at what rate we will be offering the loan? These are the 3 questions, sir.
So, basically, new customer acquisition will definitely go up actually because last 2 years we are not able to, while we acquired some customers, but it's not really optimal. Definitely we would go little high because the branches are there, and both companies will start acquiring customers, which will help us. Probably we will not be able to give exact number, but it should be more than 8 to 10% while we what we are targeting for next financial year. That's our estimate and expectation. In the case of 3-year loan, probably it will go to about 25 to 30% of the total portfolio of microfinance. But as we acquire more customers, that will come down. Currently, because it is squeezed because we are not acquiring many customers, we have higher vintage customers sitting in the book. That is why it is little high. As we start acquiring more and more customers, this percentage will come down. But for the vintage customer, it's good strategy. There is a lesser EMI load, and then continue to provide the what we call credit line products so that the products are available for them, and along with the continued 3 years loan. In case of yield, it is little difficult to say geography-wise, but what we did is high risk geography, we actually put a premium on a higher pricing. Low and medium pricing. So overall, the pricing will be between 8.75 to 18.75 to 21.5 is actually fixed currently. For example, I'll give an example of state. Maharashtra probably the high risk at this point of time, which will actually be in the higher pricing geography, which will be tracked every quarter or every half year, recheck and see and all components of the pricing. And if there's a change, we will reprice again. And also we took one more strategy of benefiting to the long-standing clients, long vintage clients. What we observed that after 3 to 4 years of experience with us, we found the risk is coming down near to zero. So for them, we are charging 1% lesser than the normal price. So overall, it's about 1.25 to 1.5% higher NIM potential, but probably 50% will be in cash during this financial year, and we will get the full benefit for the next financial year.
Sure. Just one clarification, you mentioned 8 to 10% growth in client base, active client base next year, right?
Correct.
Thank you. That's it from my side.
Thank you. The next question is from the line of Digant Haria from GreenEdge Wealth Services. Please go ahead.
Hi, sir. My question is a little more on these new guidelines. Because in the past 7-8 years, we've always seen that any form of regulatory easing has eventually been misused by the industry in terms of like over lending and just trying to not implement those things in spirit. So what are the risks that you see in these guidelines? That is it possible that maybe in the next 1 year we see over leveraging again, and despite of us being conservative, we have to face all the industry issues. So any thoughts on this? Because I think it's now 2 months, and there have been a lot of thought on those guidelines. That would be really helpful, sir. Thank you.
Thank you, Digant. So, one side we observe that there are leveraging issues or over lending. Unfortunately, the regulation was one-sided and only for one entity. That's why we have seen some difficulty. So that's the whole reason the industry went back to regulator asking for a common guideline. Correct. So whereas SRO was able to control NBFC MFI, but others there was no really extended control by SRO. Whereas they have banks or SFBs or NBFCs have different rules. So obviously there will be a different regulation, different way of doing the business by different entities, which definitely resolved by the current RBI guidelines. And now that every micro lender, irrespective of the entity nature, has to follow one common guideline, and also directly regulated by RBI, comes under the one common regulation, maybe supported by SROs. We believe that this discriminatory in terms of products or services might change, might come to control. Having said that, while we observed that last 7-8 years, there was no such over lending. But if you see the data, there's only 4.5% customers borrowed more than 3 lenders actually as of December 21, and only 7.5% of borrowers borrowed more than 1 lakh rupees. So it is not that there is a huge mis-selling or giving loans also. It is not. But there are some geographies, some districts might have had some issues, but otherwise, by and large, everybody followed the rule. There are small black ships anywhere there in every business, so I don't think that should be the key problem. But yeah, overall, 98-99% people have followed the rules. Otherwise, just to give an example, MFIs can give loan up to 1.25 lakhs actually since 2015. But average outstanding for borrowers still around 40,000 only. So which validates that MFIs have behaved very responsibly.
Right, sir. So thank you for this. So the second and my last question is, because last 2 years have not really seen a lot of new disbursements or new borrower addition to the whole industry and to our fold also. So do you think the with MFIs again starting disbursement, the liquidity itself can also help rural India? So if you can just give some some flavor of what happened in last 2 years versus what is the sentiment or the real cash flow situation in rural India. That's it from my side, sir.
So liquidity flow will always help to boost the rural economy, and MFIs are at the forefront to do this. And see, disbursement was not there only for few in the last financial year or previous year. For example, last financial year, almost 7 months people have disbursed money, like Grameen, many others have done. We believe that there will be good customer additions, also good disbursement in the rural, which will definitely help the bottom of the pyramid. So and with the liquidity available across, so we should not see any difficulty for MFI to raise money. Of course, there is some sentiment about cost of borrowing, but yeah, that is there. We can't help because it may be even if 1% increase or 2% increase for our borrower, actually they are paying just 10 rupees more per week actually. So they don't mind too much about the price, which will be much lesser than their alternative borrowing from money lenders. So that's why I don't think this will be a negative impact on them. However, there is some inflationary trend which are talked about, but our belief is that inflationary variation also is not a deep impact on the rural folks, because they also generate the product, they sell the product, they buy the raw material, they also use for consumption. In the buying and selling, they actually take the inflationary cost automatically, so net impact on them is less. To give an example to you, at least 55% of micro customers are in dairy business. They take care of cow and they sell milk. Probably their milk price would have gone up by 2 to 3 rupees. Probably some fodder price would have gone up. So net impact probably either positive or flat for them, even though in the inflationary tendency. So we don't see too many challenges. Given that we assume this year will be stable, there will not be too many disturbances. I think industry also will be able to establish themselves in the rural and the deep interline, and which will help the bottom of pyramid definitely.
Thank you, sir. Thank you so much.
Thank you. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Just one question. In your opening remarks, you had said that due to new guidelines, there would be some slowdown in disbursement as you attune to the new guidelines. If you can elaborate on the same, that what do you intend to do in terms of household assessment, or if you can elaborate there as to what you need to do.
Yeah. See, regulation asks you to do assessment of household income. That we are doing already. That is not the problem. Actually, problem is to digitize the data and data going to bureau, and bureau needs to be ready for that. That's the challenge. Bureau yet to be ready for that. That is first challenge. Second one is you also need to get the household liability side or a borrowing side, which again dependent on the bureau, multiple bureaus, microfinance bureaus and the consumer bureau, and you need to get the total view of the family in terms of all borrowing from all members of the family from all bureaus, and giving it the one view about what is the obligation of them against the household income. So these are all currently not automated. It takes time. Bureau will take time to get a common view for you to get all other bureaus. Today, what we have to do is we have to generate from individual bureaus and manually aggregate it and see what is the obligation, what is the income, and then what we can lend. So many of that latency will be there for first few months. And that's one side of the bureau and the household. In the meantime, we also need to train our entire field staff on household income and its bureau and its FOIR, because they need to be aware about every fact to explain to our customers also. No? So these all will be a challenge in the first few months to implement everything, and also with the inefficiency of some manual work with the bureau data in the household data. That is why we said that first quarter may be muted due to this kind of inefficiency where we have to work.
Right. And in this process, in the interim, do you suspect that banks or universal banks may have slightly higher edge, or all of the participants would have to readjust?
No, actually, this rule is for everybody. Everyone has to do this activity. Without that, they cannot lend. In fact, the whole industry will be, as per me, whole industry will be muted for first quarter.
Right. Understood, sir. And you think second quarter should normalize, right? I mean, it should not last beyond, let's say, 2-3 months.
Exactly.
Great, sir. Yeah. Thank you and all the best, sir.
Thank you. The next question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Yeah, hi, sir. Congrats on a great set of numbers. So just two questions from my side. So one is on this regards regulation. So of course, it helps us in terms of pricing our loans much better than the earlier cycles. But if I have to look at the let's say the entire regulations impact on P&L, how do you see net it will impact us? Because see, our operating cost is likely to go up because now we have to get the comprehensive bureau report. Wherein so earlier we might be taking only a borrower's bureau report, wherein now we have to take all household members' bureau report, and then there is operation cost also involved because field staff has to spend a bit more time on the field assessing the income of the household. So if I have to factor all these things, how do you see ROE impact of this new regulation? I mean, let's say there will be margin accretion for sure, but if I have to adjust for the higher operational cost, how should it look like on the ROE?
So actually, it will be impact initially for few months. Actually, when you do manually some of the things, when you automated, it won't be too costly. This increase will be priced anyway. And Ramesh, what happens when you start pricing the customers? The pricing today is based on your cost of borrowing, cost of running the company, cost of operation, and cost of risk, right? So if your cost of borrowing, cost of operation goes up, obviously the price will get passed on to that extent. So we don't see that very high that it can be 15 but still we have opportunity to reprice every quarter. That's why the net in case there is increase in cost of operation, still it won't eat up the margin. That is what our view. But in any case, we are not expecting the overall OPEX is going up actually, because it may remain muted for this year, because every year we are seeing about 10 to 15% reduction. We may not see the reduction this year, and from next year on we will see reduction. So to that extent, we don't see an impact of OPEX because of the regulation.
Got it. Helpful, sir. And secondly, again, linked to the regulation. So now, we are allowing to build the 25% of non-qualifying assets. So do you see that this is the opportunity for all MFI players to diversify and build the secured book? And structurally, the industry can move to, let's say, 50-50, if at all, I mean, assuming regulation will further allow you to build a 50% maybe over 3 to 5 years.
Yeah, I'm not sure about 50% because that we hope it will happen over a period of time. But this 20% definitely helps the industry to stabilize to some extent with the at least some percent of non-microfinance book or a secured book or a stable book. So this is a start point. Maybe it takes 2-3 years for the people to really build it, because all of us are expert in microfinance, so not expert in other products. It needs time, slow, and you have to build it carefully. So, but in total period of time, we would see this resiliency of diversified books in the microfinance segment. Sorry. So it's potential definitely.
And what is our plan on that front?
We too, we already told about it. We already planned many secured products and unsecured products also for graduate customer in terms of individual loans, two-wheelers, asset-backed loans like LAP, and also affordable homes. These are the 3-4 segments. Also the gold loan product. The 4-5 type of products we are piloting right now. So we would see good traction this year, and then probably scaling up will be possible during next financial year. But the pilots are already some pilots already begin. Some of them are in the process of piloting. So this year we will definitely see the pilots, ensure the right business model, so that we can scale up next financial year.
Got it. And just the last follow-up on that. So, of course, this building up the retail assets will require a higher OpEx, because we need to have the collection team. The entire process has to be different from, what we have been doing on the MFI side. So even after factoring, some of the upfront investment towards building the retail assets, net cost to assets, where should it settle in 2024?
Yeah. There won't be any increase of our operating cost, because we have manpower already acquired. We have branches set up already. So we have a technology investment already made. So we don't have any. We are not expecting any increase except hiring the right people for the field. Other than that, we don't see any. That's why overall impact on the cost will be very negligible here.
And any thought on building up the separate collection team for retail assets?
Yeah, as we move, we will do definitely. So as we move for example, even for microfinance loan, we have a separate collection team now. So obviously we'll build for that also. As the portfolio build up, we'll start building that also.
Okay. This is helpful, sir. Thank you very much, sir.
Thank you. Next question is from the line of Abhishek Murarka from HSBC Bank Limited. Please go ahead.
Hi, good morning, sir. Thank you for taking my question. So 2 questions. One is, what portion of MFL's portfolio is now as per CredAccess rules, so underwriting rules? And why are the yields different between MFL and CredAccess? Is there still a difference in the customer profile, or is it because of some other computational reasons? So that was my first question. I'll come back to the second.
No, actually it's only the borrowing cost variation slightly, because MFL borrowing cost is higher than CredAccess, but we were trying to make it lower. We reduced almost 2% in the last 2 years, but we still have some gap between CredAccess and MFL in terms of borrowing cost. So, and plus there probably because of the acquisition is little high, and OpEx also little higher than us. That's why this variation you could see.
Okay, and what portion of MFL's portfolio is now underwritten as per CredAccess rules? I think it was 35% last quarter.
65% now.
Okay.
65%.
All right. And my second question, sir, is when you study this, customer information to figure out the FOIR and how much headroom you have in terms of being able to give a loan, do you see any differences between states? Do you see the headroom being higher in some states, southern or western? So any sort of comment or insight on that would be useful.
Maybe it is too early to give get the insights, Abhishek. Probably another 1 or 2 quarters time we will have significant numbers, because we just made that role. Hardly we dispersed less than 100 crores in the new model. So probably we'll try to highlight next time if possible. Right now we don't have on specific insights.
Thank you. Abhishek, I'll request to come back in the question queue for a follow-up question. The next question is from line of Piran Engineer from CLSA India. Please go ahead.
Yeah, hi. Thanks for taking my question. Just had a couple of questions. Firstly, in the last 4-5 quarters, our customer count has not changed, but our loan book is up 30-35%. And now next year also we are targeting 8-10% customer growth to 25% loan growth. So over a 2-year period, basically customer leverage is up 50%. So how comfortable are we really with this strategy here? And my second question is, we've also started 3-year, 10-year loans. Have others in the industry also started this? Thanks.
Yeah. So on the customer leveraging, it is more of a for the last 2 years issue where we are not able to add customers for many months in the first year and second year, whereas we had to lend to the customer who are already finishing their loans. Automatically, based on the vintage, they will get little higher loan than the earlier loan. So our presentation clearly depicts the nature of increase the portfolio. Now we clearly see that the CAGR increase of GLP per borrower is not more than 10-15%, which is maintained continuously, and the increase in borrowing is only for the vintage customers. So non-vintage customers, the portfolio for customers remain same. Probably that slide depicts clearly about how this increase happened. And the second question is, sorry, I just missed. You also said No, before that you also said that our growth is 25%, whereas customer acquisition maybe 10%. In microfinance, the customer growth and the portfolio growth should not be more than 25%. The difference, that means if the growth of customer is 10%, portfolio growth cannot be more than 30-35%. That is the thumb rule actually. If you do more than that, it is leveraging. But if you see here, we are talking about 10-15% variation between these two, which will not leverage the customers. And with the inflationary trend, the requirement of borrowing for the customer, vintage of the borrower, which all adds to the customer portfolio. So that's why we don't see any leveraging issue here. And on the 3-year loan, we really don't have good insight about others so far. Whereas we started the 3-year loan almost 1.5 years back. So it's not new. We are only highlighting new actually because the EMI load, sometimes people assume that the outstanding it goes up, whether there's a load on customer. That is why we clearly depicted here again. When the customer, even though that's leveraging or the outstanding per borrower goes up, simultaneously tenor also goes up, so that there is no load on the customer. The table what we made in that page 7, it clearly says the same loan of 10,000 rupees. If it is, what happens? What is the EMI? If it is 1 year, 2 year, and 3 year. So load on customer will be lesser. So that is why there is no additional risk because of giving a higher loan for the higher vintage customer.
Okay, sir. That answers my question. Thank you.
Thank you. The next question is from the line of Alpesh Mehta from IIFL Securities. Please go ahead.
Hey, hi, and thanks for taking my question, and congrats for the good set of numbers. Just 2 questions. First is, sir, the comment about increasing ticket size. Most of the lenders are giving more or less a similar kind of a comment that since last 2 years, the customer acquisition has not been that great, and the vintage of the customer has increased. So, the question over here is, till the time the bureau records are being updated, is there a possibility that in the last 6-8 months, the leveraging of the customers would have increased meaningfully? And simultaneously, is that also one of the reasons why we are seeing some kind of an improvement in the asset quality at the system level? The second question is related to the other comprehensive income. So there is almost 100 crores plus kind of a charge that will be classified to the P&L in the future, in the ensuing quarter. So what is this regarding? And lastly, onto the margin stuff, competitive intensity, while obviously RBI has given us the leeway in terms of increasing the pricing, but would the competitive intensity restrict that, and are we increasing the processing fees? Thank you.
I have to go back to one by one now. First is about the increase, last 5-6 months delay in updating the bureau. There is no delay in updating bureau by anybody. So and no MFI have lent without checking with the bureau or reporting to bureau. So the SRO ensures that every MFI reports on time and takes the bureau report before lending. Therefore, no chance of MFI or anybody lending without a bureau data. So that's why that question is not I said something clearly. The second one is said about comprehensive income. Other comprehensive income. Nilesh, you have any insight?
Also, that is basically entry which is passed on account of fair valuation of the loan assets. So the loan assets which we typically which we hold eligible for selling under a direct assignment transaction. So those assets we typically book in our balance sheet as fair value assets. And accordingly, as the interest rate changes, valued and the entry is passed through the OCI directly into the reserves. So, I mean, last year you must have seen our lending rate was reducing every quarter, and in fourth quarter it was almost at 19.05. So it is more of a accounting entry which needs to be made.
Under India, you have to publish that outcome.
Okay. And just the last question on that processing fee, are we planning to increase it?
Yeah, we actually, considering that there is a cost of operations slightly going up, we had increased the processing fee by 37 bits. So which takes care of all the expected increased topics in our lending.
Okay, and lastly,